We are diving deep today into an event that the analysis report is calling a space-based supernova. We're looking at Sidu space, ticker SIDU, which didn't just have a good day. It ripped a staggering 38% higher in just one session.
It really was an explosion. And the sources we've got are, they're aggressively bullish. So for anyone watching that ticker, the question is obvious, right? Was this just a flash in the pan, some kind of temporary pump, or is this the real deal?
Exactly. Is the path actually open for Sidu to hit that $10 analyst target?
And that's our mission today. We have to dissect the data behind that massive move on January 3rd.
Right. We need to go beyond just the price tag and figure out what allowed it to smash through resistance and, wake up the entire market.
Well, when a stock that's usually pretty quiet suddenly jumps almost 40% in a day, you have to scrutinize it. You have to ask if it's just speculation or if the market is genuinely repricing the company based on something new.
Okay, so let's unpack this. The core numbers are, well, they're pretty dramatic. SIDU closed the day at $4.33. That's up $1.19, or about 37.90%.
And the momentum didn't even stall at the closing bell.
No, it didn't.
It kept pushing, hitting 456 in after hours. That tells you the demand. It just wasn't satisfied by the end of the day.
But as you said, the price is just the result. The real story, the thing that validates this rally, it's the volume.
Oh, absolutely.
And here's where it gets really interesting. The analysis points out that over 142 million shares were traded. For a stock that's normally pretty quiet, that is an almost seismic spike.
That volume figure, that's the institutional fingerprint. When volume jumps by that much, you're looking at way more than just retail buyers. It's a huge sign that big institutional funds are opening up new positions. Big volume validates big moves. Without it, a 38% rally is just noise.
So what did all that liquidity actually do on the chart? The sources say it didn't just break resistance, it hit a new 52-week high of 444. And by doing that, it went into what traders call blue sky territory.
And that blue sky term is so important. It completely changes the psychological landscape of the trade. It means the stock is trading at a price it hasn't seen in the last year, so there's no immediate overhead resistance.
Okay, explain what that means for the listener, because it sounds a little bit like jargon.
No, it's very practical. See, when a stock is trying to move up, it often runs into people who bought higher before and are just desperate to sell and break even. They create a kind of selling pressure.
The ceiling.
Exactly, a ceiling. But in blue sky territory, that natural selling pressure is gone. The stock is free to run purely on new demand and momentum.
So you've got record volume and a blue sky breakout. That's the classic technical recipe. But big moves need fuel. The analysis lays out 3 key drivers for this rally. What were they?
The strength here is that it's not just one thing. It's a convergence of trading mechanics, some major fundamental news, and just broad sector sentiment.
Okay, let's start with the mechanics. Driver number 1, the short squeeze setup.
Right. And what's fascinating is the specific setup here. You had short interest. The number of people betting the price would fall, hovering near 15%. And that was combined with a relatively small float.
Remind us what the float is and why high short interest and a low float is basically a recipe for volatility.
The float is just the number of shares actually available for the public to trade. So when a big chunk of those few shares are held by short sellers who have to buy them back, you get leverage. It's like trying to push a giant balloon through a tiny door.
And the huge volume spike is what forces them to do it.
Precisely. That initial buying surge forces the short sellers to cover their losses. They have to buy the stock back no matter the price. That forced buying creates more demand, which pushes the price higher, trapping even more shorts. It's that classic feedback loop. That's how you get the sheer velocity of a 38% move.
But I have to be skeptical here. Short squeezes are temporary, right? They can hide deeper problems. If the shorts finish covering, doesn't the momentum just die?
That is the perfect question. And it leads us right into driver number 2, which is the long-term justification here. The core argument is that Sidu space is transitioning from being seen as, a speculative penny stock idea into a legitimate government-validated defense contractor.
So the market is fundamentally changing how it values the company. What's the specific data point that proves that?
It's their involvement in major defense contracts. Specifically, the analysis points to their position in the $151 billion IDIQ vehicle.
Okay, that sounds like a lot of jargon. Lay it out for us. What is IDIQ?
IDIQ stands for Indefinite Delivery, Indefinite Quantity. It's military speak. Think of it like being on a pre-approved vendor list with a massive budget. It doesn't mean Sidu gets $151 billion, but it means they've passed all the security and manufacturing checks. They're now a certified, reliable supplier the government can place big orders with.
So instead of having to bid for every little job, they're now on the inside track for recurring, substantial government revenue. That makes the company way less risky.
Exactly. It changes their risk profile overnight. It signals they've moved from concepts into actual revenue-generating, validated manufacturing. That's a game changer for how the market sees them.
And this feeds right into that phrase analysts love, space as a service. Why is that model so important for a $10 price target?
Well, space as a service, or STACE, is all about recurring revenue. Traditional space companies built a satellite once. It was a one-off payment. This model is about providing data, imagery, support, ongoing services for government and commercial clients.
So they're moving from being the carpenter who builds one house to being the utility company that gets paid every single month.
That's a perfect analogy. And the market rewards those utility-like revenue streams with much higher valuations because they're predictable.
And finally, driver number 3 is the broader context. The whole space sector is just hot right now.
Yeah, if you zoom out, the entire global space sector is booming, driven by defense and geopolitics. When a lot of money flows into a high-risk, high-reward sector like space, stocks like Sidu, with that fresh validation and small float, they often benefit the most. They're like a compressed spring.
So it's a powerful combination.
Right.
The technical squeeze, the fundamental validation from defense contracts, and a huge sector tailwind.
Right, and that brings us to the big question. What about that path to $10? Or more specifically, the average analyst target of $10.20. Is that even grounded in reality?
Let's focus on the rationale. The analysts have been quietly bullish, mostly because of that space as a service model.
And that's what underpins the $10.20 target. That number represents a potential upside of, 135% from the close? But the analysis adds a really important reality check here. The big target doesn't matter if you can't clear the hurdles right in front of you.
Which brings us to the next battleground, the $5 mark. Why is $5 so critical?
$5 is a major psychological milestone in the market. It's a round number where a lot of institutional funds set automatic buy and sell orders. Breaking through, and more importantly, holding above $5 proves the buying conviction is strong enough to absorb all that automatic selling.
So holding $5 validates the whole rally. It sends a signal that this repricing is real.
Precisely. If it can build a base of support above $5, the path to double digits suddenly becomes much, much clearer. If it fails there, then that technical pressure from the squeeze might just fizzle out.
So the next few trading sessions are really a battle for that psychological level. But what about the risks? You don't get a 38% gain in one day without inviting some volatility.
That's the necessary caution. A run-up like this naturally brings out the sellers who want to lock in their profits. The analysis says a pullback isn't just a possibility, it's a probability.
So where does the report suggest a healthy support level might be? Where could the stock catch its breath?
It specifically points to the 350 to 380 range. A pullback to test that level would actually be seen as healthy and normal. It lets the stock consolidate, shake out the weaker hands, and build a stronger foundation for the next leg up towards $5.
So for you listening, the key takeaway is to expect some volatility. Don't panic if you see a 10 or 15% drop from the highs.
That's right. And beyond just market volatility, there's a systemic risk for these kinds of companies. The dilution caveat.
Ah, yes. Raising capital by selling more stock, which can push the share price down temporarily.
Exactly. Space is incredibly capital intensive. These companies are always hungry for cash for R&D and manufacturing. And often, the fastest way to get that cash is to sell more shares. When they do that, it increases the total share count and can cause a temporary dip in the price.
So even if the fundamentals are pointing to $10, a surprise stock offering could hit the price hard, at least for a bit.
It's the classic tension between short-term price and long-term growth.
Yeah.
So anyone tracking SIDU has to watch for financing news just as closely as contract news.
But the bullish analysis frames all this risk a little differently, doesn't it? How do the bulls view these potential dips?
For the bulls, this volatility isn't a threat, it's an opportunity. They see any dip that happens on lower volume as a golden opportunity to buy in. The idea is that once the stock consolidates, the fundamental story, the defense contracts, will take over and drive it towards that $10 mark.
So to summarize our deep dive here, Sidu Space has had a massive technical breakout. It was kicked off by a perfect storm of a short squeeze and record volume, but it's being sustained by real fundamental validation from defense contracts and this whole space as a service model.
And the key takeaway for you is that this isn't just a trading glitch, it's a powerful convergence. The chart is in a new yearly high, and the analysts have a framework for a move to $10.20.
But the immediate test, the litmus test for the whole thesis, remains that technical and psychological barrier at $5. That's the battleground.
And that leads us to our final provocative thought for you to think about. Given that all this long-term bullishness is tied to this shift, this move to a space as a service model and major defense involvement, What does that signal about the future of all small, specialized space companies?
Yeah, are these speculative tech firms becoming essential, recurring subcontractors that are basically just permanently embedded in the military-industrial complex?